Right, good afternoon, everybody, and welcome to the latest webinar in our Tax Update for Professionals series. As usual, we've got 4 presentations on different topics and different areas of tax from Vicky, Paul, James, and myself. Feel free to send in questions as we go along. I will pick them all up though at the end and deal with them then, if that's okay for everybody, just to make sure that we get through this within the hour, which is always the plan. The presentation is being recorded, and so that will be uploaded onto our website in due course after we've finished. So if you do need to revisit it, please feel free to go back and do so. So without further ado, I will start off with our session on corporation tax and business taxes. Now, what I wanted to do here was touch on the changing corporation tax rate from next year, but specifically looking at the point around associated companies and how that's going to impact upon matters. Just as an overview, as you'll probably be aware, the main rate is going up to 25% from next April. There will still be a small companies rate at 19%, but that's only for profits up to £50,000. The main rate of 25% will apply to profits over £250,000. And then we'll have this marginal relief on the difference in between. Now, of course, when we're looking at that £50,000 and £250,000 limits, we do reduce those by the number of associated companies. So the rules that we had back in 2015, if you can remember that far back, those are all coming back in to determine how many associated companies we have, and therefore to what extent those rates of £50,000 and £250,000 will be reduced. Now, as we're going to have to think about associated companies, again, what can we do to maybe manage and mitigate that situation? Well, first of all, we could look at maybe rationalizing the number of companies we have. If there are 2 or 3 companies doing broadly the same thing, can we bring them together? Does that make sense from a business perspective? We could look at merging companies, divisionalizing within individual companies. A few things to think about there. Now, the associated companies rules, they're also going to be important from a quarterly installment payment perspective. So again, for accounting periods commencing after 1st of April 2023, we're going to use the associated company definition rather than the 51% group company definition when determining whether we are in the quarterly installment payment regime. So we may have many clients and companies who previously were outside of that because their related companies were all separate. They weren't in the corporate group. Now we could find more of those being brought into this regime whereby your tax payments are accelerated considerably. We should be looking at nearly dormant companies. You know, what I mean by that is that companies who may have a handful of transactions going throughout the year. Now, they will be classed as an associated company. If they're doing something, they will be associated. There is an exemption for holding companies in groups, but that is quite tightly drawn in that there are specific criteria that company needs to meet. Very broadly, its only assets can be the shares it holds in subsidiary companies. Any dividends that get paid to it have to flow through to the ultimate shareholders, and it can't have any other income. So there are some very specific criteria there that it may be difficult to meet. And what we're looking at is any company that was associated at any time during the relevant accounting period. So just being associated for one day can mean that it's an associated company for that whole period when we're looking at the various implications of that. So what is an associated company? So one company is associated with another if one of them has control of the other, or if both are under the control of the same company or person and persons. And when we're looking at control, we're looking at the definition in section 450 of the 2010 Corporation Tax Act. And it's a person is treated of having control of a company if they exercise, are able to exercise, or are entitled to acquire direct or indirect control over the company's affairs. So it's not just about votes, it can be about other factors as well in terms of determining whether we have control or not. So again, it can be quite wide-ranging. So in particular, and this is drawing down on that definition of control, if an individual is entitled to the greater part of the share capital, is entitled to the greater part of the voting power, the distributable income, and that can include a notional distribution, and the net assets on the winding up. So again, reaffirming what I was saying before, it's not just votes, it's all these other factors as well. And what we also need to bear in mind, that shares held by a person's associates and other controlled companies are attributed to them unless we have this concept of there being no substantial commercial interdependence between the companies. I'll come on to this shortly in terms of what that means and how that can apply. So we're looking at individuals themselves and potentially their associates. So when we're looking at trying to establish whether two companies or more are associated or under the control of the same person or persons, what HMRC do is to look at the minimum controlling combination. So this is the combination of persons who control one company, but that same combination can control the other. And it's the minimum combination of those individuals. So it's a group of persons who has control of the company, but which would not have control of it if any one of them were excluded. I'll just go through an example shortly, which shows how that could work in practice. So two companies would only be treated as associated with each other if they have that same minimum controlling combination. And hopefully this will help in terms of demonstrating that. So here we've got two companies, A Limited and B Limited. In A Limited, Mr. Watkins has 60 shares, Mr. Ings has 20, and other unrelated shareholders have 20. In B Limited, Watkins has 40, Ings has 30, and the other shareholders have 30 between them. And here we're assuming none of the shareholders are related to each other. So when we're looking at the minimum controlling combination, Watkins and Ings can control both companies. They can control company A because they got 80% between them, and they can control company B because they got 70%. However, Watkins can control A on his own. So he's the minimum controlling combination. Now, he doesn't control company B on his own, and therefore A Limited and B Limited are not connected because the minimum controlling combination in this example is Mr. Watkins by himself. And whilst he controls A by himself, he doesn't control B by himself. Now, an important aspect of looking at associated companies is this concept of attribution of rights of associates. So not only do we need to consider the rights of the shareholders themselves, it's any rights that could be attributed to them by associated persons. And here I've just set out the definition of what includes that concept of associated persons. That's in section 448 of the 2010 Corporation Tax Act. So it's relatives, and here we're looking at the lineal route. So it's parents, grandparents, children, and then spouses. Business partners can be associates. The trustees of a settlement created by that individual are associated, or the trustees of a settlement created by a relative. And the trustees or personal representatives of any settlement which holds holding shares in which that individual has an interest. So what else are could be attributed? Any company controlled by them, or any company controlled by them together with their associates. But the process, importantly, doesn't extend to associates of associates. So you don't keep going down the track to work out what that minimum controlling shareholding might look like. So relatives, like I mentioned, generally include direct family relationships. So it doesn't include aunts, uncles, cousins, nephews, and nieces. Now, just reaffirming what I was saying before, if we do have additional companies under common control due to the attribution of rights of associates, then we need to consider this concept of substantial commercial interdependence. If there is no substantial commercial interdependence, then there's no need to include the rights of associates. So this is important. So you could have two companies that are at first look connected and have common control if you attribute the rights of associates. But if they aren't substantially commercially independent upon each other, then they won't be associated. So we're looking at three types of linkage here when we're determining whether two companies are interdependent or not. So we have financial interdependence. So that's the extent to which one company gives financial support to another. Economic interdependence. So realizing the same economic objective, the activities are a benefit to each other, or they have common customers. And organizational interdependence. So that's where they have common management and employees, maybe common premises, common equipment. Unhelpfully, substantial isn't defined anywhere in the Corporation Tax Manual. It implies that a 10% test should be used, but it's the overall picture ultimately. And what interdependence means, it implies that each company must be dependent in some way on the other and vice versa. So it's not just looking at dependency being one way. Ultimately, the application of the social commercial interdependence rules, it is a subjective one and will depend upon the facts and circumstances of each case. Right, well, thank you for listening to that. I will now hand you over to Vicky to pick up on the private client side of things.
Thank you, Craig, and good afternoon, everybody. Today, I'm going to do a slot talking about the tax implications of divorce. Now, this is a topic that obviously can apply at any time, but since April 2022, the Divorce, Dissolution and Separation Act 2020 has reformed the divorce process to remove the concept of fault. And there has been recent Law Society data that suggests that new divorce applications have almost doubled since the changes came into effect. So it may well be an area where you're receiving more queries. So the fact that this act has come into place to remove the concept of fault allows couples to focus on the key practical decisions such as children, finances, and the future. But as well as that, it's obviously also important for them to consider the complex tax implications that can apply around divorce and how to minimize that tax liability as far as possible. So the key aspects that I'm going to look at in this slot are what the concept of living together is, and then I'm going to go through some capital gains tax points, talking about the importance of timing, and often it's the family home that's something that's considered here. And then I'm going to touch on some other aspects, including the transfer of business assets, some inheritance tax comments, and also touching on some income tax aspects. So let's have a look at the concept of living together, because that's important for the tax rules surrounding divorce. So individuals who are married to or in civil partnership are treated as living together unless either they're separated under a court order or deed of separation, or they're in fact separated in such circumstances that separation is likely to be permanent. So then looking at the timing aspects for capital gains tax purposes in particular, timing is important when considering the transfer of assets between divorcing couples, so working out how their estates are going to be separated. If you're married or in a civil partnership and you live with your spouse or civil partner, then any transfer of assets between you will not usually give rise to a taxable gain, because it's treated as taking place as no gain, no loss transaction. So the recipient inherits their spouse's or civil partner's original cost. Now, unfortunately, this rule only extends to the tax year of separation, but that's only if you have lived together at some point in the tax year. So you do need to look and consider the points very carefully to ascertain when these timings are. And from the 6th of April following separation, whilst you may still legally be married or in a civil partnership, the nil gain, nil loss rule no longer applies. And so divorcing couples would be deemed to be connected persons for capital gains tax purposes. Now, the result of that is that any transfer after the tax year of separation of assets would be deemed to take place at market value. So you would get a capital gain arising. So you would have a liability to capital gains tax, even though there's been no cash exchanging hands, so no way of funding that capital gains tax if it is payable. So now moving on to consider one of the key assets that needs careful consideration as part of the divorce process, and that is the family home. That will often be the major asset to be considered, and it's important to consider the tax consequences, either if it's needing to be sold or if it's being transferred to one of the parties as part of the divorce proceedings. Now, obviously, where you've got a family home and that's the only or main home, you've got to think about how much principal private residence relief is available for capital gains tax purposes. And that may or should be available on the gain where the property is or has at some point been used as the couple's only or main residence. Now, as a reminder, married couples and civil partners cannot have more than one main residence between them at a particular time when they're married. And so after the tax year of separation, each spouse or civil partner would be entitled to nominate separate properties as their main residence for principal private residence relief purposes, because they're treated as separate for those purposes. And principal private residence relief is always available for the last 9 months before disposal or transfer if the property has been occupied as a main residence at some point during that period of ownership. So applying that to the situation at hand, sometimes the departing spouse or civil partner from the property would leave that marital home and transfers their share of the property to the remaining party. Now, since we've said that principal private residence relief is always available for the last 9 months of ownership when the property's been an only or main home, if such a transfer takes place within 9 months, then there wouldn't be any capital gains tax due, because principal private residence relief would cover the whole period. But that doesn't really seem realistic to get through all of the discussions that are necessary to sort proceedings out in only a 9-month period. So there are some special rules which can help in these circumstances, but it is very important that each case is considered carefully and the facts are ascertained in detail and it's worked through to check that your understanding of the capital gains tax position is accurate. And this is something that we're reasonably regularly asked to help out with from referrals in from solicitors or from individual clients to consider the position for them. So there is an extension that applies where the leaving spouse or civil partner from the property transfers their interest in the property to the other spouse under a court order. If the transferee has continued to occupy that property as their principal private residence throughout the period since the transferor left the property, then it's extended. Principal private residence relief is from the date of the transferor moving out until the actual date of transfer. But there are specific rules that have to apply, and it isn't available if the transferor has elected for another property to be their main residence during the same period. And also the claim can only be made if the property is being transferred, and this doesn't apply at all if there's a sale of the property. So as you can see, there are nuances that need to be considered there. So moving to consider a different aspect and other things that can often arise in divorce proceedings is business assets, and considering whether there could be any capital gains to pay on those. Now, as we said, if an asset is transferred from one spouse or civil partner to the other after the tax year of separation, that transaction will be deemed to take place at market value. If the asset is a qualifying business asset, and we don't have time to go into all of the details here, then holdover relief might be available to reduce or even eliminate the immediate charge to capital gains tax. But care really must be taken, because HMRC's view is that such transfers under divorce are not a gift, and so holdover won't apply. Now, this is getting fairly technical, but I've put on this slide a capital gains tax reference within the HMRC manuals that has a section talking about transfers of business assets on divorce. And this indicates that care should be taken in identifying the consideration that's passing, because the revenue's approach is that the gain eligible for holdover relief could actually be reduced to zero due to the value of rights surrendered, and the fact that consideration for these purposes is not limited to just money or money's worth. So if you are in a situation where there's business assets transferring and you're thinking that holdover relief would be due, do check that manual and the position in detail, just to check that you couldn't come into problems if the revenue look at this in the future. So moving on to another aspect, and this is considering inheritance tax and also touching on some aspects to do with wills. So transfers between spouses and civil partners are generally exempt from inheritance tax, and this rule continues during the period of separation until the decree absolute is granted. So the inheritance tax rules are very much more favourable. But just as a reminder, if one of the spouses or civil partners is non-UK domiciled, the interspousal exemption is limited to £325,000. Now, transfers after the decree absolute has been granted under the terms of the court order may still be exempt from inheritance tax, provided that there's no intention of conferring any gratuitous benefit. And maintenance payments to a former spouse or civil partner should always be exempt from inheritance tax. So hopefully, the inheritance tax implications should be easier to sort than the capital gains taxes that we've talked about before. Now, divorce doesn't revoke an existing will, but it does have some important consequences to a will. So the current will does remain valid, but for inheritance tax purposes, the ex-partner is treated as if they died when the marriage or civil partnership was dissolved. Also, if the ex-partner is down as an executor, then they would no longer be allowed to act in that capacity. So because of these things, and because obviously if divorce proceedings are started, even if they're not completed, it might change the way in which you'd want assets to pass if something happened to you. It is very important that wills are reviewed and updated accordingly. And potentially it might mean updating your will at the start of divorce proceedings, and then again once they're completed, to check that it's still in accordance with clients' wishes. Now moving on to income tax. Transfers between spouses or civil partners under a court order are not subject to income tax. But it may well be that a spouse may receive income producing assets, and that could mean that they may not have had to do tax returns before, but they might now start needing to do them if their income exceeds certain thresholds in terms of the requirements to submit tax returns to HMRC. So that's something to make sure that individuals are aware of. And often when couples are going through a divorce situation, it might be that one of those parties starts looking for advice from someone else because they wouldn't necessarily want the same company to act for them, and you'd want to make sure that you had, barriers so that the information wasn't shared. So obviously divorce can be an opportunity for other parties to become involved, either for doing tax work and also for giving investment advice, for example. So as a conclusion, the tax consequences of divorce can be significant and should be discussed with clients and considered and talked through. There are various pitfalls to navigate, and it's important not to assume that everything will be all right, and to educate individuals as to the situation and what they need to consider. Specialist tax advice should be sought as early as possible so that it can be properly thought through and considered as part of the negotiation process, and to ensure that assets are distributed in the most tax efficient way for both parties. I hope that that's been a helpful whistle-stop tour through some of the key aspects to do with divorce. And I'll now pass you on to James with a topical VAT update. Thank you.
Thank you, Vicky. And as Vicky says, I'll be spending the next 10 minutes or so running through some topical VAT ideas. VAT is the common thread here, and what's prompted the things I'll talk about over the next few minutes is largely HMRC making some public announcements and issuing letters and notifying some policy changes. So we'll get straight into the first one of the first area I'm looking at is making tax digital. I think most people are familiar with MTD now, the idea that you must keep digital records, or at the very least have some kind of filing arrangement using bridging software whereby you can file your VAT return and have a digital link with HMRC. And MTD has been extended to all VAT registered businesses from the 1st of April this year, with very limited exceptions. And HMRC have just published a couple of short papers around MTD. And one of them does raise the point that actually there are exceptions, exemptions, in fact, from the requirement to be MTD compliant if it's not reasonable or practical for a taxpayer to use computers or special software or use the internet. And in fact, there are some businesses that do get HMRC's agreement for maybe if someone's located off the grid and their electricity supply is variable, then they can't rely on submitting through MTD. If the business is located abroad, it might not be easy to get the right software and so on. So that's something to think about in a limited number of situations. HMRC have also said that since MTD first came in several years ago, that they think it's boosted compliance and boosted the VAT yields, but there's no compelling evidence of that in my view. But one thing that HMRC have done recently in relation to MTD is that they've announced through a brief the penalty regime for non-compliance with MTD, which in essence is £400 penalty for failing to submit a return using functional software. And then there are penalties of at least £5 a day, rising to £15 a day for not keeping digital records. Now, these penalties are actually a very old set of penalties from the days of paper records. So there's nothing particularly modern about the penalties. But I think what it does do is show that we're leaving the period of a light touch approach by HMRC and moving towards an approach where HMRC are looking to get more revenue yield. Now, the next topic I'm looking at, I've actually got two slides looking at two different points about imports. HMRC are in the process of writing to every VAT registered business at the moment to explain that the CHIEF system, CHIEF stands for Customs Handling of Import and Export of Freight, that system is being phased out, and the Customs Declaration Service, which is maybe a less snappily named system, is replacing it. And this is important to any business that imports or exports. And what's happening at the moment is that the chief system that we've had for at least 25 years is being phased out. As the slide says, you can't use it for import entries after the end of September and for exports after end of March next year. And the new system is coming in. The chief system is an old system that has become outmoded, partly because of the volume of transactions that are now generated as a result of Brexit. There are several hundred million more import and export entries than the old system was designed for. And the new system is meant to be very software driven, data driven, whereas the old system was very much to do with paper entries and generating import certificates on paper that went out in the post and so on. But the changeover from one system to the other is actually happening 3 years later than scheduled, which is an indication of some of the teething problems that we've had with this. Why is it important to all businesses that import and export? It's because there is an action point, which is, at the very least, if you're a business that imports and exports and uses a customs agent, what you need to be doing is ensuring that your customs agent or freight handler is fully compliant with the new customs declaration service and is not reliant on chief, and therefore things won't get caught once chief gets phased out. For other businesses that are now linking their own accounting systems directly with the customs declaration service, then there's clearly quite a bit of preparation that needs to be done to make sure that everything is working smoothly after the chief system is phased out. Now, as I said, the new customs declaration service is very much about software and coding of entries within the accounting system and linking through with HMRC systems to generate import certificates and so on, and proof of and declarations. And as part of this switchover, HMRC have designed what they call the trader dress rehearsal. And when I first looked at that, I immediately had an image of dress rehearsal. I thought, oh yes, you sat in the theatre and the house lights are dimming and curtain goes back, but there's nothing particularly exciting in prospect other than a package that's been designed by HMRC, which is about training your staff, practicing various import and export scenarios, testing your own software. But the fact that they've designed this dress rehearsal package for businesses to use, I think, to me, conveys some nervousness on the part of HMRC about whether the whole system will be up and running, given that we're already over 3 years late in switching over. And so they do say it might take some time to make sure that everything's up and running for doing your import and export entries and so on. You need to liaise with your software provider to make sure that everything works. So it really is something to focus on now. My second slide and point on imports is rather briefer. It's a reminder about the postponed import VAT accounting system, which is where you, instead of the traditional way of paying import VAT over to HMRC, either directly or through your customs agent, and then once the monies have cleared, you can then bring the goods through customs into free circulation. In fact, the postponed accounting means that you can account for your import VAT through your VAT return. So the goods can be cleared through customs straight away without any delay, and you pay the VAT over to HMRC in your VAT return and simultaneously recover it if you're a fully taxable business. And whatever your personal views about Brexit, this is definitely a success story, I think, in relation to Brexit, because it applies not just to imports from the EU, but to all imports from around the world. HMRC have issued some guidance recently, which again, I think reflects some teething problems in setting up the new system. In particular, there have been some ongoing problems for importers making access to their monthly import statements. So in the old chief system, you would get a monthly certificate through the post, which was your evidence to recover import VAT. Now the monthly statement is generated on the system and you can get it through going through your government gateway account. But there have been delays in issuing these statements. There have been errors with them and so on. And so what HMRC have done in their most recent guidance, only a week or so ago, is restate that there are ways in which, if you've got problems getting your statements, you can do a sensible estimation of your VAT and then correct it later. And as long as you take a fair and reasonable approach, everything should be okay. What this does also do, in my mind, with looking at the area of imports and so on, is something that I've seen with a number of clients in recent times, is looking at whether you need a VAT registration overseas and looking at your supply chain and so on. And so I think a point that has come up a few times is when you're looking at things like that, like your import process and accounting for VAT, you also need to be mindful about where you're moving goods around and whether that might trigger a requirement to register for VAT elsewhere. My next slide is again picking up some recent HMRC announcements, a couple of which are actually prompted by some court decisions, and HMRC have reflected on those and announced some policy changes. Now, the first one is, first of these bullet points is looking at the area of the DIY builders claim. And I mention it because there's a general point to bring out as well. If you're a house builder, a commercial house builder, by and large, you get your VAT back because when you sell the house, it's zero rated and it's a taxable business activity. And so most commercial house builders are on monthly VAT returns and they get VAT repayments on their costs. If you're a DIY builder and you're building your own house for a non-business purpose to live in it yourself, then there's a special scheme called the DIY Builders Scheme, which means that you can put in a claim to recover VAT that you incur, subject to a set of rules about what's claimable and what isn't. But the idea of it is to put the DIY builder on the same footing as a commercial builder. And then in a recent case called Ellis and Bromley, the claimant had put in a claim to recover VAT on their house, but they put their claim in too early. HMRC's rules say that you have to put the claim in once the house has been completed, and you then have 3 months to put your claim into HMRC. And the rules say that you can only do one claim. Well, these people put in their claim, then it was too early, and then they realized they had more VAT to recover after completion. They put a second claim in, and HMRC refused the second claim and said, no, you can only put one claim in. The case went to the VAT tribunal, who said, well, actually, the law doesn't say that at all. The law doesn't say a DIY claimant can only make one claim. That's purely a matter of HMRC policy. And as well as it not being what the law says, it's also not logical because it's not putting a DIY claimant in the same position as a commercial house builder. And so the tribunal threw out HMRC's arguments. And so then we move on to, well, what's HMRC's response to losing this case, which was very clear in saying that HMRC's policy didn't reflect the law. Well, HMRC have issued a brief and they say, our policy is to accept only one claim, and it hasn't changed. And so immediately it's at odds with what the tribunal said that the law says. And HMRC have sort of contorted themselves to say, yes, there is only one claim, but if we've paid an earlier claim in error, we'll allow you to make a second claim. But their policy just doesn't reflect what the law says. So to me, it's very misleading. And the third point on the slide here about business and non-business, this applies to charities and not-for-profit entities. And again, I mention this one because I think that HMRC have really not necessarily reflected what the courts have said. In this particular area about business and non-business, the classic example is if you have a charity or a not-for-profit organisation that has non-business activities, they can normally get their property zero rated and get their property VAT free. So a classic example, and there are a couple of court cases around this in the past, is a charitable children's nursery that offers childcare, makes a nominal charge that doesn't cover the full commercial cost of provision. That's seen as a non-business activity because there's no profit motive. Anything that's paid is looking to be seen as a contribution towards the costs. It's clearly not commercial. And on that business basis, the organisation can get its property VAT free. Now, the Court of Appeal came up with a decision in a case 4 years ago now that turned that on its head and said, actually, where a charity is making a charge for an activity, in this case, it was a sort of outward bound type activity, because a charge is made, then that must be business because there's consideration, there's some money changes hands. Now, even though the evidence was that the charity in question relied on volunteers and donations and the charges didn't cover the cost of providing that activity, the court still felt that it was business because a charge was made. And it's taken HMRC 4 years to come up with a response to this case. And they said, actually, the set of rules that we follow to determine whether an activity is business or non-business, that set of rules that relied on the old Lord Fisher case about a gentleman at his stately home having organised a shooting party and contributions to that, the old Lord Fisher tests that we've all relied on for 30 odd years, those are set to one side, and there's a new approach to deciding whether something is business or non-business. But then HMRC's brief goes on to say, well, in working your way through the new tests, you can use the old Lord Fisher tests to help you chart your path through the new tests. So that seems confusing. And then there's nothing in the guidance to say that when this new approach will come in. So what happens if you've got a trustee of a charity and you've just signed the contract for a new building on a VAT-free basis? Does this new brief apply to you now, or is there a transitional period and so on? So again, it's unsatisfactory. It's important for people involved with charities and not-for-profits, but it raises more questions than it answers. The final point on the slide is going back into the commercial world, and it's making a point there that with the domestic reverse charge for businesses that make wholesale supplies of things like mobile phones and computer chips, previously until now, there's been a requirement to submit a return when you have transactions above £5,000. That domestic reverse charge return requirement is being ended from 1st of July onwards. Very briefly on my final slide, I thought I'd throw in some points trying to look for something a bit more positive with all the talk of recession and so on that we've had of late, is just a reminder that there are a number of cash flow ideas around VAT. I've highlighted a few on the slide here. It is things like, well, if you're a small business, maybe if you're below the turnover threshold, you can deregister. If you've got bad debts, you could set up a system to claim bad debt relief, which can be made after 6 months. You don't have to wait till the end of the year when your accounts are done, as long as you follow certain conditions. A lot of businesses have their accounts payable position is closed quite close to the month end, which could be at a VAT quarter end. And actually, there might be a lot of purchase invoices that come in after the AP is closed down, or come to the accounts team after approval for payment and so on. So you could have a system to make sure that you claim VAT on those invoices and bring them into the return according to where they're dated, rather than roll them forward into the next return. There are special rules around continuous suppliers of services. So very often that's accountancy, bookkeeping, legal, professional services with retained clients, whereby a tax point is created where you raise an invoice or receive cash. Well, maybe you can delay raising an invoice by sending out a request for payment instead. And you can do other things like maybe moving to monthly VAT returns if you're in a repayment position, or changing the quarterly stagger for your VAT returns to fit your business better and improve your cash flow. So with those cash flow ideas, that concludes my comments on VAT, and I'll hand you across to Paul Clark.
Good afternoon, everybody. I'm going to run through 3 topics with you this afternoon in the field of tax investigations and enquiries. The first one I want to look at is, in the days of the pandemic, particularly in the early days, the government and HMRC were under pressure to get as much income support out to businesses as they possibly could. And we're well familiar with the furlough scheme that was widely used by a number of employers. But what about the situation for the self-employed taxpayer and client? And you will no doubt have had some of these clients who were able to claim under the self-employed income support scheme, SEAS, and they received, or were eligible to receive in principle, a number of tranches under this arrangement. And what HMRC have said as recently as April is that they are going to look at how these claims were made and the propriety, if you like, of those payments that were made out to those taxpayers, particularly focusing on claims made under the 4th and 5th grants most recently. What they are seeking to identify is whether, when the application was made, the turnover test was correctly applied by the client. For example, if the turnover, by comparing the reference year to the more recent year, was down by at least 30%, then they would be eligible for a grant of 80% of 3 months of the average trading profit at a maximum of £7,500. If the turnover was down by less than 30%, they would be eligible for 30% of 3 months trading profit with a maximum of £2,850. And what HMRC are seeking to do is identify whether, in the cold light of day, those applications have been made correctly, because if they were made for the higher grant, then they expect that difference to be repaid if the client was only eligible for the smaller grant. And similarly, if the 5th grant application shouldn't actually, in the cold light of day, have been made, for example, the application will have been made by the client indicating that for the year 2021, and those tax returns are now in, so they are in HMRC's records and are being looked at, that the grant application was made, that there was a downturn against the comparison year's turnover. So there was a basic eligibility. But if now that the returns are now in, demonstrating that actually the 2021 turnover wasn't lower, then the grant should not have been applied for. And HMRC are looking to recover these amounts that have now been paid out incorrectly. And what they will do if the client doesn't voluntarily repay is that they will go through their records and issue assessments. Now, they are likely to be correct because they'll be based on factual information. But if an appeal is required, then there is the normal 30-day process for the client to lodge an appeal. HMRC say they will be writing out to taxpayers as opposed to emailing them. And they make the point, therefore, that with the number of scams that are out there these days, be mindful that there may well be scam emails sent out saying to clients that they should be repaying under a certain arrangement. Well, those scam emails plainly should be ignored. HMRC will only contact the client in writing in these instances. And that letter will specify the due date for the payment of the excess grant. And if the payment date isn't adhered to, there will be late penalties that apply. For example, starting at 5% for the first 3 months and increasing if the delay carries on. And similarly, there will be interest on the late payments outstanding after 31st of January 2023, which is the filing date for the 2021-22 tax return. Bearing in mind that the rates of interest are creeping up, we saw last week an announcement by HMRC that the rate from the 5th of July will be increasing to 3.75%. Second topic I want to cover is looking again at tax avoidance schemes that we've looked at previously, and HMRC have identified one particular type of avoidance scheme that was promoted by one particular individual who was quite high profile at the time. I won't fully name that individual other than to say that he and I share the same Christian name, but that's where the arrangement and the similarities promptly end, I might add. This is for non-employee benefit trust schemes. They've previously been covered off in earlier settlement opportunities, and it similarly isn't offered to employer-funded retirement benefit schemes. It's specifically looking at a particular type of tax avoidance arrangement known as remuneration trusts. They were set up in a number of instances and taken out by certain taxpayers. I personally haven't seen any of these, but I'm aware that they have been taken out. And what it involved was the setting up of a personal management company alongside a remuneration trust. And the payment, once it had been made by the client company into the trust, was then paid over to the management company. And HMRC's view is that this is no more than disguised remuneration, and it fails the legislation and thereby is pay-as-you-earn and national insurance related. What HMRC are saying is that they offered this to begin with from the 11th of April, and the settlement opportunity ends in just over a month's time on the 31st of July, together with full calculations that will be required. In HMRC's view, the remuneration trust cases often were flawed, not only in structure, but in implementation. And thereby there was no valid transfer of funds. By the very nature of this particular remuneration trust arrangement, the opportunity and the settlement terms are quite complicated. And HMRC have said to try and encourage people to actually settle the tax liabilities that HMRC believes should be due in these cases. At worst, it will produce the sort of financial outcome that, were it to go to legislation, then the court judgments would reach. There will be interest due, but not penalties, if the taxpayer took, as they say in these cases of no penalty, reasonable care over their tax affairs. And that's what would have to be argued to make sure that there was no penalty due, but there will be interest due. If means is an issue, and HMRC are mindful in many cases now that clients don't always now have ready funds to settle these liabilities, which in themselves can be quite substantial. There will be installment options available, but it will very much depend on the client's individual circumstances. But there will be the opportunity to apply if certain criteria are met. The third area that I want to look at with you is the ongoing saga of off-payroll working and employment status. and the latest position with IR35 cases and how these are being interpreted when they go through the tribunals and the courts. There are two cases that you may have heard of in the press, because they are not new in one sense. They have gone through the tribunals. Both Paul Hawksby and Kay Adams cases were commented on a year or so ago at least, but they've now reached the Court of Appeal, and it's the first time this intermediaries legislation has actually reached the Court of Appeal in IR35 cases. It was the same panel of judges, and they reviewed the same two cases, or these two cases in parallel, but they came up with very different outcomes. And it just shows how difficult it is to advise on how these cases actually fall for tax purposes. Paul Hawksby had a personal service company known as Kickabout Productions Limited, and he presented on Radio Talksport. And in his case, it was all to do with, was there sufficient mutuality of obligation to provide and perform the work, and was there sufficient control in existence to demonstrate that there was an employment relationship between the parties? Paul Hawksby won at the first tier tribunal when HMRC had issued assessments for PAYE and NIC, but it was overturned in the upper tribunal when HMRC appealed, and HMRC won. So Paul Hawksby took this case to the Court of Appeal, which was not a cheap measure to take. He failed in the Court of Appeal. They refuted his arguments. They upheld HMRC's arguments, and there was a clear decision there that he thereby fell foul of the IR35 legislation. Whereas, if we take the Kay Adams case, she had her own personal services company. She'd been operating as a freelance journalist for a number of years through a company known as Atoll House Productions. And the dispute here was the work that she undertook with BBC Radio Scotland through that personal service company. The Court of Appeal had to consider whether Kay Adams was in business on her own account, and thereby the mutuality of obligations and control issue were less of an issue. The case here was much more finely balanced. And unusually, the decision in this case, even though the Court of Appeal said that they could see HMRC's arguments, and were the Court of Appeal to make the decision themselves, they would probably, by the way the commentaries go on this case, that they would have found in favour of HMRC. But what they decided to do, very unusually, they said that when they looked at what the tribunals had considered and the way the tribunals had weighed up the arguments, they hadn't considered the right arguments. So what they have said is that they will send the case back to the tribunals, probably the upper tier tribunal, for them to rehear the case. And it just goes to show how difficult it is, not only to go through these lengthy processes, but to identify actually, ultimately, are these IR35 cases or aren't they? Because HMRC's CEST tool is by any measure and is well known as being pretty, as the commentaries put it, close to useless, not least because it's over-reliant on the substitution factor, and it's too framework based, whereas you can see from the two cases we just looked at that substitution wasn't an issue at all. So what needs to happen is there needs to be a clear definition of what is a person's status for tax purposes once and for all, not least because there is no recognition in tax terms of what a worker is in employment law terms. So it's still very uncertain. And there we are.
Thank you, Paul, and thank you to James and Vicky as well. I hope you all found that of interest. I'm very conscious that we're just touching on 3 o'clock now. We haven't had any questions come through, but as always, please feel free to drop us a line if anything was of interest to you there. Like I mentioned at the start, this is being recorded and will be on our website shortly. Just one point I'd just like to throw out there just to end with. We obviously been doing this as a webinar brought on by the pandemic, basically. We did hold these sessions in person previously in the offices here. I just welcome any thoughts anybody may have in terms of whether they would prefer to go back to the in-person meetings, whether you're happy to keep them in a webinar format. I am conscious that there are a number of you who tune into this who don't live nearby Leeds, so logistically it would make it very difficult for you to do so. We may run a combination of the two. It's just, we just want to give it some thought and do something that works for everybody. So please let us know on that front. Thank you again for listening, and we'll be back in about 3 months' time with a further update. Thank you.